The FOMC is about to make its move. It's gearing up to deliver its third consecutive 0.25 percentage point rate increase while continuing to allow assets to roll off its nearly $8.6 trillion balance sheet in its year-long campaign to get inflation under control. All eyes are on the FOMC as they navigate this delicate balancing act to ensure the stability of the U.S. economy without risking a recession. Let's get into it. All right, guys, welcome back. The Fed's policy statement is going to be a pivotal moment for the market. Investors will be watching closely as we know what is expected to be revealed in this statement.
I don't know what they're going to say in the statement, but I expect that they're going to raise interest rates by 25 basis points. That would bring the Fed funds rate up to about 5.25. It's not necessarily what I think that they should do, but I don't get a vote. They don't have a lot of options right now, and I don't see the Fed as being a organization that's ever can be accused of having a lot of original thinking. So that's what I think is going to happen.
Right. They're probably going to raise by 25 basis points, but I think the statement is going to be what moves the market. The market's pretty much expecting that 25 basis points has been telegraphed. The way things have gone the last 2 years, Mr. Powell has a credibility issue, and if he backs off now, if you're saying that they're going to do it, that plays into that some more. But I think the statement will say, we're going to pause and wait for the data, but they're going to sound hawkish. They can't let the market off the hook right now because there's a big risk of inflation reaccelerating.
So if the Fed does pause rate hikes, what is the risks that are associated with them doing that too soon? What has happened in the past when that's occurred?
So, yeah, as Thomas said, the risk is that if the Fed eases up off the brake, if they decide that they're going to pause, that inflation will come roaring back. There is a parallel now to the 1970s, at least that's what a lot of people were saying. Believe it or not, I was still a little too young to remember that part of the 70s. But at that time, the Fed did lower interest rates, they raised interest rates, and then inflation started coming down, similar to what's happening today. They paused, and then in the late 70s, inflation just came roaring back because the Fed paused too early. I'm not necessarily sure, though, if we've already let that horse out of the barn. The Fed did backstop the banks in March, and they introduced a bunch of liquidity into the market. Call it a bailout, call it a backstop, call it whatever you want. But I think we're going to start seeing in the CPI numbers and the PPI numbers next week that inflation's already going to be starting to tick back up.
Well, that's very possible. And like you're saying, the parallels, Chris, they eased back on their pace of hikes just last fall into 2022. And what happened the first part of the year? Inflation reaccelerating. The market, the economy is ready to go. The Fed has got to make the economy know inflation has to stop, right? If you look back in the data, you can see that inflation made a two-stage ramp as it increased. And right now, the data is showing some slowdown. And if they pause, they kind of back off too soon, the risk really is that inflation will just subside to a lower level, but still be well above the target rate. And so then they'll just be back to raising interest rates again.
Thomas, do you think avoiding a recession is even possible at this point? I know last week we talked about a shrinking GDP later this year, but even the Fed has mentioned a recession and they're putting the blame on banks. I know you have strong feelings on this. Can you tell me about that? Chris, get ready because I'm going to want your thoughts as well.
It's funny how Mr. Powell says the banks are going to cause a recession without mentioning the trillions of dollars of stimulus money that got put into in the economy, all of the demand and all of the inflation that caused that led to interest rate hikes, which is why the banks are failing. So the banks are a symptom of the recession that's coming, but they're not the cause of it. The cause of it is stimulus money, pandemic stimulus, the surge of demand, and the rise of inflation. So inflation is still kicking, interest rates are still high. The things that we're seeing, especially in reports from the likes of UPS and Packaging Corporation of America, is showing a sustained and system-wide slowdown in consumer demand. And that is one of those things that will build or produce a negative feedback loop, like we've been talking about before as well. You know, as demand slows and companies have to control their costs, they start cutting employees and cutting services and stopping their own investment. And that just has a rippling effect to the economy and compounds problems that we already have. So I think recession is here. I think what we need to know now is how bad it's going to be, because I think that it could get pretty bad before it's over with.
Yeah, and I actually I agree with Thomas that I think the recession's here, and I'll take it one step further. I've been of the mindset that the recession's been here for quite a while. In 2022, we had the 2 consecutive negative quarters, negative GDP quarters. That has always been the telltale sign of recession until 5 minutes ago, when it didn't fit what the administration wanted it to say.
Exactly.
So we said it wasn't a recession. I tend to believe that it was. And so I guess in that sense, we've been sort of fortunate, because we've sort of been in a soft landing for probably about a year. I expect that landing is going to get a little bit bumpier now, because the Fed is going to raise interest rates now. And you're already starting to see credit conditions tighten for consumers. You're already starting to see credit standards tighten for businesses. So I do think now we're going to be entering a different leg of this recession than where we've been in.
Right. So Chris, just on your point with the data, and we've already been in a recession, I want to point out the index of leading indicators.
Yeah.
Index of leading indicators are the index of economic indicators that tend to lead the market. They lead the economy. If the economy is growing, they'll grow first. If the economy is shrinking, they'll shrink first. So the index of leading indicators has been negative for over a year. That shows that the leading part of the economy has been in contraction for over a year. Now, the data has kind of, trended up and down from month to month. Sometimes it's more negative, sometimes it's less negative. But if you look at the chart, you'll see that the negative peaks are getting progressively worse. And this is just the economy telling us that the indications of negativity and recession are getting stronger and stronger. Right now, I think the economy is at a tipping point where it's still chugging along and it's still fueling inflation. And when it tips the other way, we're going to be in a firm, full-blown recession that people just can't talk their way out of it.
All right. So how is the market currently pricing in the Fed's expected rate hike? What does this tell us about the market's outlook?
The CME FedWatch tool is probably the best way to judge that. Right now, it's pricing in about a 70 or 75% chance for a 25 basis point hike next week. Beyond that, I think July is pricing in a high probability of the Fed just being flat, neutral, no changes to policy. But the meeting after that, this is like July, August, maybe early September, whatever, the next meeting after that, there's a chance that they could start cutting interest rates. And that really depends on the data. So the pause would be to see how the data comes in. If the data suggests that inflation is slowing, they'll pause, and they might even start cutting rates. And speaking of data, the PCE price index is due out tomorrow. I'm not sure if our video will be out before then, but that data will absolutely 100% sway the market's feeling about what the Fed will do. It's expected to be on the hot side, not accelerate. It's supposed to come down a little bit, I think, on a YOY basis. Month to month, it's supposed to be pretty flat, 0.3% from last month. The takeaway here is that core PCE inflation is still running above 5%, and it's going to stay there for a while. Even with the trend, let's call it a trend of decelerating inflation, we're still well above the Fed's target rate. Now, they cannot stop. They can start pausing, but they cannot stop. They cannot start cutting. They cannot start cutting anytime soon.
Yeah, I support most of everything that Thomas just said. If the markets were rational, the markets would be down a lot more than what they are right now. But I've given up on the markets being rational a long, long time ago. The way I've seen it for a while is I've seen what's been going on for the last year or so as being the market and the Fed are playing this enormous game of chicken. And the basic fact is everything that Thomas said is true on the economic indicator side. And that's why I said the market should be down more than it is. But what the market knows, what institutional investors know, is that there is a limit to how high Jerome Powell can raise interest rates. They know this because there's going to come a point in time where the US Treasury is not going to be able to service its debt. I saw some figures. I'm not going to get into that because it doesn't make very good video from the Congressional Budget Office that says by 2053, just the interest on our debt alone is going to take up 40% of the tax revenue that we bring in. And by that time, that means it will be we'll be paying more in the interest on our debt than we do on defense spending, Medicare, and Social Security. I mean, it's a frightening number to anybody that wants to look at it. And it just says
really
that at some point, the markets know, to what Thomas just said, we may not be seeing interest rates go down, but we're probably going to see a cap to how high they can go. And markets can tend to deal with that. But it's just the idea of not knowing necessarily how long they're going to stay high. However, once it becomes difficult for the country to service the debt, then the Fed really only has two options at that point. One is to cut interest rates, and the other one is to just start printing money, which is going to flood liquidity in the market. Either outcome is bullish for stocks. So I'm not saying that, again, I'm not saying anything that Thomas has said is incorrect. I'm just saying I think that's really explaining what's going on in the market, because really there's a lot in the market that's just unexplainable right now.
All right. So as we've seen, the FOMC's actions can have far-reaching effects, and the market is on edge with many uncertainties hanging in the air. Is there anything else the two of you want to add that we need to take away from today's discussion?
Well, I guess not to be a downer, but I would just caution investors that, I mean, I know that Fed watching has become a spectator sport, but honestly, you know, if they're looking for a barometer for what's going on with the economy, what's going to be going on with the favorite stocks, you know, they really need to be paying attention to energy policy, monetary policy, government spending. I think this conversation that is not happening between Congress and the president about the debt ceiling limit is not nothing. I think it's something that should be getting a lot of attention. And all of those are issues between now and through next year, 2024, and an election year, that investors should be paying a lot more attention to. What the Fed does on a meeting to meeting basis, I honestly don't think it's not that important for their portfolio, honestly.
Right. Like Chris was saying, there's really not a lot that the Fed can actually do. What they should have done was raise rates more aggressively at the beginning, but that's a whole different conversation. Jerome's been behind the ball the whole time.
Absolutely.
But Chris, I think what you're telling us, and I kind of see this happening too, is that we've entered a new normal. Inflation's not going to come down to 2% for a very long time. The Fed is going to keep interest rates at a high level for a very long time. I think we've entered a cycle where maybe inflation slows and the Fed slows, and then inflation picks back up and the Fed picks back up. Because what it's going to take right now is an actual recession that pulls the floor out of the oil price. If you look at the oil price is part of the ramp of inflation that we talked about before, and oil price has stabilized above levels that it is traded at on a regular basis for more than 13 years. So it's like 13-year high levels where it's trading on a regular basis now. And that is a price point that's going to underpin inflation throughout the system. We might see some slowing of it, but it's not going to come down substantially. And so long as the economy is still kicking and there's still an outlook that the supply-demand situation is going to be favorable to oil price is going to stay high. And if it accelerates, inflation will reaccelerate.
Thank you both so much for your insights today. We'll keep an eye on this and report back soon.
Right. Thanks, Lacey.
Thank you, Lacey.